provincial, federal, and marginal tax. Tax. What's the first things come to your mind when you hear the word tax? Mine is government. Wow, they are like we're paying a lot of tax. If you're passing this course, I can assume that you have worked before. So part of your hard-earned money is taxed. But do you know how much? And as a mutual fund sales rep, you have to know the difference between federal tax, provincial tax, and marginal tax. This is the base of your role as a mutual fund sales rep. Let's get to them. The first concept is federal tax. Federal tax is constant for people living in all provinces of Canada. Okay? I'm living in Ontario. Jack, for example, is living in Newfoundland. We both have same federal tax. As the name states, it's federal. It covers all the country. We do have different brackets for federal tax, starting from 0 to 50,197. So the federal tax rate for this bracket is 15%. And you can also see other brackets. The next term is provincial tax brackets. I'm living in Ontario, and I want to set Ontario as the province. Okay, I'm gonna look into Ontario's tax brackets. Ontario's tax bracket is just for people who are living in Ontario. Okay, each province has its own tax brackets. In Ontario, the first tax bracket is $0 to $49,231. The tax rate for this salary in this bracket is 5.05%. Now, any working individual in Canada pays both federal tax and provincial tax. We pay both of them, okay? When we combine both of them, we get to the term marginal tax, okay? So, marginal, let's get to the marginal. Marginal means combination of federal tax and provincial tax. The tax brackets are, let's get to the tax brackets in marginal tax. $0 to $49,231. The marginal tax rate is 20.5. Where do we get that 20.5? Just take a look to the federal tax. The first bracket, 0 to $50,197. The tax rate is 15%. Now, this 15% plus, take a look to the first tax bracket of Ontario. Our example is Ontario here. It's 5.05%. So, the marginal tax bracket for that bracket, 0 to $49,231, is some of these federal and Ontario or provincial tax brackets, which is 20.05%. The next tax bracket is marginal tax bracket starts from $49,231 to $50,197. So how do we get 24.15%? Just sum the first tax bracket of federal with the second tax bracket of the Ontario. So 15 plus 9.15 equals to 24.15. Why do we sum the first bracket of federal with the second bracket of provincial? Because our bracket starts from 49,231 to 50,197. Okay? Take an example of $50,000. Let's say somebody earns $50,000 a year in Ontario. Okay. The federal, so for the first $49,231, he needs to pay 20.05% of that money. The first 49,231. He needs to pay 20.05% of that money to the as taxes, both provincial and federal. The rest of that, which is $769, he needs to pay 24.15% of that $769 as taxes. Okay, so 50,000 is in second bracket of Ontario tax brackets and in the first bracket of federal tax bracket. That's why to calculate, to get to the second bracket of marginal tax rates, we sum up the first bracket of federal tax to the second bracket of, with the second bracket of Ontario tax rate, and we get to that 24.15. Let's get to the example to elaborate it. Like, okay, let's say somebody earns X amount of money. Okay, how much do they pay tax on that income? Let's get to the example. So, challenge or example of provincial, federal, and marginal tax. Let's say NAV's gross employment income is $130,000. I wish. Calculate the tax he pays on his income. Don't consider tax deductibles and tax credits. Okay, this is just for learning. Do not consider tax deductibles or tax credits. And we have the options there. Okay, feel free to stop the video and calculate it yourself first if you know how to do it. If not, just continue the video. No worries, we're gonna learn it here. Okay, so NAV's income is $130,000. Okay, so NAV's salary will go under different tax brackets. Let's start with the first tax bracket. So he's gonna pay 20.05% of his income as tax. So we're gonna multiply 0.2005 by 49,231. We're gonna get that much. Then he's gonna pay from 50,197 minus 49,231. Okay, this amount, like it'll be less than $1,000. He's gonna pay 24.15% of that less than $1,000 as tax. So it'll be $233. The next marginal tax bracket is between 50,197 to 98,463. So we're gonna we're gonna get this tax bracket amount, which like we're gonna do 98,463 minus 50,197 multiplied by this what's the third tax bracket's like tax rate? It's 29.65%. So we're gonna multiply that and we'll get $14,311. And we're gonna do like that exam, like exactly like that. We do have, so this salary, which is $130,000, goes under different tax brackets, and we calculate the taxable income just using marginal tax. Okay, we do have marginal tax. Why bother yourself and go calculate federal first and then provincial? We just do it with marginal. That's why we do have different tax brackets. This income goes through these tax brackets, and we calculate amounts for each, the taxable amount for each bracket. Then we sum up all these brackets, all the taxes we get from these brackets, and we get to the final taxable tax that NAV needs to pay, which is $36,249. So the right option is option D. Okay, so on your final test, you won't get question like calculate taxable income or the amount of tax. No, you won't get this type of question. We are learning it just because you need to understand the basics. And this calculating the provincial tax, federal tax, marginal tax, and knowing the differences of these types of taxes is your foundation as a mutual fund sales rep. Okay? So I guess we now understand the difference. To calculate the tax, we just use marginal tax. Any salary would go through different tax brackets. So, for example, if the salary is $70,000, okay, it only goes through tax bracket number 1, 2, and 3. Okay, don't bother tax bracket number 4 when your salary is less than 98,463. This is the easy way to calculate the tax that you need to pay or your client needs to pay to the governments, both federal and provincial. Great, let's get to the next topic. Personal tax calculation. Okay, we learned how to calculate the tax on our income, both federal and provincial, using marginal tax. Okay, and remember in the question we said do not consider tax deductibles or tax credits. Okay, the tax that we calculated in the previous example and previous topic was just tax of your employment. Okay, let's say you have investments, you have rental income, you have your business. These also generate you income, generate you money. You need to pay tax on them too. Okay, government won't let you go. You need to pay tax on every single penny or cent you make in Canada. And so in this topic, we're going to learn about different types of income, then about tax deductibles and tax credits. Okay. When you're filing your tax on, in Canada, we do it it starts late February and continues until April. Every year, any individual who works in Canada needs to file a tax. Okay. But what factors or what components we need to be fully aware when we're filing our tax? Okay, Let's say we're gonna file a tax, okay? We need to calculate our personal tax. The first step is calculate total income, like everything you have earned in the previous year, okay? Total income is sum of employment income, so you work somewhere and they pay you. Business income, you have your own business, or you work somewhere and you are also self-employed. Especially these days, everybody needs to have 2 jobs to, survive. Killing. So, total income is sum of employment income, business income, investment income. If you have invested in something, let's say bonds, equities, and different dividends, different types of investments, you get income. You need to pay tax on them too. And investment income plus capital gain. Capital gain means whatever you earn from stocks, okay? Common shares, when you trade common shares. So total income is sum of these 4 components, okay? But we need to consider 2 points when calculating total income. Point number 1, when we calculate investment income, okay, there are 2 types of investment income: dividends and interest income. You get dividends when you invest on preferred shares, and you get interest income when you trade or invest on bonds or debentures. Okay, your interest income, you need to fully report your interest income. There is no tax treatment on interest income. Okay, this is very, very important point. There is no tax treatment. There is no credit. There is no deductibility on interest income. You need to report all the interest income you earned from bonds. But for dividends, there is tax treatment. Okay. So to calculate in your investment income, you have interest income plus gross up your dividend income by 38%. So you have your dividend income multiplied by 1.38. Why? We will get it in the 4th step of this topic. Okay, this is slide. I'm gonna explain why. Because government give you tax treatment on dividends. Okay. Point number 2, when calculating total income, just 50% of your capital gain is taxed. Okay, so your interest income, fully taxed, no tax treatment. Dividends, you need to gross it up your total received dividends by 38%. So multiply that dividends by 1.38. Your capital gain, what is capital gain? Your stock is, you bought your stock at $10. Now it's $25. Okay, this 15% is your capital gain. Okay, you only report 50% of your capital gain to the CRA, or Canada Revenue Agency. Okay, so these 2 points are very, very, very important, and you are gonna question, and there are 2 questions just from this 2 little points. Okay, again, I'm gonna repeat it again. Your capital gain, just 50% of your capital gain. Okay, your dividends, gross it up by 38%. So multiply your dividends income by 1.38. Your interest income, fully taxed, no tax treatment. So we sum up all those 4 components: employment income, business income, investment income, dividends and interest income, and capital gain. Okay. We now have the total gross income we made last year. Okay. Step number 2. Now is the time that tax deductions comes in. Okay. Let's say the total gross income from like all 4 sources are $80,000. Okay. Now, second step, we need to deduct some tax deductibles. So, tax deductibles duty is reducing your taxable income. Okay. When tax deductible comes in, your total, if your total income is like the higher total income you have, the more tax you pay. This is the simple thing that everybody knows. Okay, the higher income you have, the higher tax you pay. Tax deductibles duty is reducing that total taxable income. So it tries to reduce the total income you made last year, so you pay less tax. Okay, what's the most like common tax deductible? It's RRSP. We're gonna talk about RRSP in future. Okay, a little bit in this chapter and more of it in the next chapter. But RRSP is the most common tax deductible tool. Each year you got, like, depending on your income, you got 80%. You have a room called RRSP, 80% of your gross income. Okay, you can transfer money to your RRSP and deduct that when you're filing tax, and you can deduct that money that you have transferred to RRSP, and you can reduce the total taxable income you had. Okay, so the second step is we have total income minus tax deductibles. Okay, so now we have new taxable income. Number 3, now it's time to step 3, it's time to calculate the tax. Okay, how do we do it? Now we do it exactly like the previous example that we had, marginal tax. Okay, let's say our total income was 80,000. Our RRSP room, we have transferred 10K to our RRSP room. Okay, now our taxable income is $70,000. Step 3, we're gonna calculate gross tax on that $70,000. How? With using marginal tax rate brackets. Okay, so if our salary is 17, our taxable income after tax deductible is 17,000, we're gonna just use the first 3 tax brackets. The 17,000 will go through those 3 tax brackets, and we're gonna calculate the gross tax. Okay, why do I say gross? Because I'm gonna go now to step number 4. The reason is step number 4. The term tax credit comes in. We do have gross tax. Now, we CRA or government, different governments offer tax credits to all individuals in Canada. We're gonna use that tax credit to reduce the gross tax we owe to the government. So remember, so there's difference between tax deductibles reduce the taxable income, reduce the total income that you need to pay tax on that income. Tax credits reduce the total tax that you need to pay, or you need to pay to the government. Okay, that's why lots of people get tax refunds, because they apply lots of tax credits. Most of them should be refundable tax credit. Okay, so Step 4 is gross tax minus tax credits, whatever you have. Governments offer individuals different types of tax credits, okay? But there is very important point about dividends. Remember dividends? We grossed up by 38%. Now, government's tax treatment for dividends. Government offers you 15% of dividend income as your tax credit. So, government grossed up your dividend income. Okay, so let's say you have earned 1,000 just on dividends. Okay, government says gross it up by 38%. So you're gonna get 1,000. When you gross up that 1,000, it'll be $1,380. Okay. Now, why did government gross it up? Because it wanted to give you more credit. Now, 15% of that $1,380 is your tax credit. Go and deduct it from gross tax you have. Okay? Now, you should fully understand and absorb the steps, the calculations of this personal tax. Okay? We started with different types of income. We had 4 types of income. We had 3 subpoints about interest income, fully taxed. Dividends income, grossed up by 80%. Capital gain, just 50% of capital gain is tax. Another point. I was going to forget about it, but another very, very important point. Okay? Dividends and capital gains are taxed. There are tax treatments on these two. Okay? Only if the issuer of these stock and dividends, okay, are Canadian. So if they are non-Canadian corporations or firms, there is no tax treatment. Remember this. Nothing. There is absolutely no tax treatment if the corporation is non-Canadian, so from out of Canada. Okay? This is the point that we needed to understand. So, we now fully know the 4 crucial steps to calculate the our personal tax on in March of each year. Let's get to the example to clarify more of these 4 steps. Okay, let's get to it. Challenge to learn the personal tax calculation, those 4 steps. Okay, this example is to absorb and to understand those 4 steps. Considering the following table, what's the net tax payable question mark? I don't know why did I read like that, but net tax payable, not gross tax. Okay, we do have some information there in the table: employment income, dividend, Canadian corporation dividend, non-Canadian corporation. Try to calculate it first. You know those 4 steps now. Okay, using those 4 steps, try to calculate this net tax payable. If you can't right now, no worries. Just continue this video with me. Okay, but I would be more happy if you could go to that previous slide and calculate it yourself first. But let's get to the answer if you're too lazy to do it yourself. Step number 1, we sum up all the income, total income. Okay, we find out total income. We do have employment income of $60,000. We do have Canadian dividend income of $7,500. We gross it up by 38%. So we multiply 7,500 by 1.38. Plus, we do have dividends from non-Canadian corporation, 2,000 dividends. There is no treatment on that, okay? Then we do have bond interest income, no treatment on interest income, so plus 3,000. Plus, now we do have capital gain selling stock, okay? How much is that? 4,000. Only 50% of that capital gain is, you need to report that. So we multiply that 4,000 by 0.5. Plus, we still have rental income. So you have a property, you have a condo, I don't know, you're renting that condo, you need to pay tax on that too. So plus 20,000 on that. So we calculate total income of $97,350. Now, step number 2, we deduct tax deductibles from that total income. What's the famous tax deductible? RRSP contribution. Okay, how much RRSP contribution we have? 10 grand. So 97,350 minus 10,000 equals $87,350. Step number 3, we calculate gross tax calculation. We calculate gross tax. Okay, $87,350 goes through the first three tax brackets, which rates are 20.05, then 24.15%, and 29.65%. We calculate the gross tax. The gross tax will be $21,341. Last step, net tax. How do we calculate net tax? We deduct tax credits from gross tax. What tax credits we have? We have dividends, so 15% of dividends, so 15% multiplied by 1.38 multiplied by 7,500. Okay, we do have that tax credit. We do have so we grossed up the dividend income. Okay, now 15% of that grossed up amount is your tax credit. We also have other tax credits. Ontario job training tax credit, $265. We're gonna sum that too. We do have Canada training tax credit, $300. We're gonna sum up that too. So taxable income, gross tax minus these three tax credits, dividend tax credit, Ontario job training, and Canada job training, equals to your right answer. Great. I think now you fully understand those 4 critical steps, okay? If you haven't understand it yet, if you haven't, by understand, I mean fully absorb it yet, just please go and watch it again, like start it over, okay? You have time. You have lots of time. You need to, as a mutual fund sales rep, the first 2 topics was informative topics. I mean, I think some of the complications in your mind have been solved because I was always like, what's marginal tax? Okay, what are tax deductibles? What are tax credits? What's RRSP contribution rule? What's interest income, capital? These should be solved on YouTube. Okay, great. Let's get to the next topic. Government pension plans. Okay, we calculated taxes, okay, that we pay Ontario, we pay our province, and we pay to federal government. But what do we get in return from governments? Okay, we get two types of government. We get like health benefits and etc. I don't want to get into them, okay, but I'm gonna talk about government pension plans. Those tax that we pay to governments, both provincial and federal, they provide us with two pension plans when we retire. Number one, Canada Pension Plan, CPP. I'm sure you've heard it a lot. And you have seen it on your pay stub because it is automatically deducted from your gross income. The second type of government pension plan is Old Age Security, OAS. I'm not sure if you've heard it before because it's not deducted from our pay stub. Let's get to the points of Canada Pension Plan, or CPP. Canada Pension Plan is mandatory contributions for all working Canadians. Everybody who is working in Canada need to contribute to CPP. It's mandatory. Okay? You can't just opt out from it. No, it's not just like TFSA or RRSP thing. It's mandatory. The second point of CPP, employers automatically deduct it from your gross income. Okay? If you're working right now, go check your pay stub. There is a term, there is a line that is called CPP. CPP tax. Not tax, CPP. Okay? So employers automatically deduct it from your gross income, not your net income, from your gross income. Point number 3, contributors. So let's say we contribute every 2 weeks, bi-weekly, okay, to this CPP. What do we get in return? Contributors receive a monthly retirement pension for life beginning at the age of 65. So when you're 65, you're going to get monthly income. From where? From these CPP contributions. You contribute to CPP. CPP will invest in different things, different securities, or even housing. And when you are 65, you will get monthly income from these contributions over the years. Okay? There are some subpoints to this age 65. 60 years old is the earliest, and 70 years old is the latest time to start getting your pension. If you start getting your pension at 60, the monthly amount that you would get is lower than 65, and 65 is lower than 70. Okay? Lazy people like me needs to start getting CPP when they are 60, and smart people, hardworking people like you will assume you will get it at 7 years old, because you will gonna get higher income, monthly income. But average age is 65. Let's get to the points of OAS, or Old Age Security. What's that? Residence in Canada for 40 years. Okay? Residence in Canada for 40 years, resided in Canada between age of 80 and for an uninterrupted 10 years before applying to for OAS. Okay. So you need to be in Canada. You need to be a resident of Canada 10 years uninterrupted to be eligible for OAS. Okay? There are some subpoints. If you have lived in Canada for the full year before the OAS approved, and if you lived in Canada for at least 3 years for each year of absence. Okay, so I think you just misunderstood, and it is too complicated, but let's make it simple. So it says if you want to be eligible for OAS, you need to live in Canada 10 years uninterrupted. Okay, for each interruption there, for each year of interruption, you need to also live 3 more years. That's the point of this simple definition of these 2 points. Okay, contribute. Okay, well, let's say we have lived 10 uninterrupted years in Canada. What do we get? We get monthly income. Contributors receive a monthly, there's no contribution, by the way, okay? Let's say residents receive a monthly retirement pension for life beginning at the age of 58. Done. There's no higher age or lower age. 58 years old. You're gonna start getting OAS when you're 58. Let's get to the last point of OAS or old age securities. There's a point, clawback. What's clawback? If your OAS says if your salary, okay, when you're 58 and older, if your salary is between 79,000 to 129,000 or 129,000, you need to pay 15% of that OAS back to the government. But if your salary when you retire is less than 79, you're okay. You don't need to pay OAS back. If you're between that bracket, your salary when you're 58, you need to pay 15% of your OAS back to the government. If your salary is more than $129,260, you don't get OAS. No OAS for you. End of discussion. Okay? But when we're 58, these amounts, these brackets will definitely be adjusted by inflation. These numbers, like in 30 years, that 79,000 is nothing, I guess, with this upward inflation that we are experiencing. Great. Will you get question from this topic? Government pension plan? 100%. No doubt. Let's get to the type of question. Feel free to pause the video. Okay. What pension may require higher income receptions to repay all or part of the payment received? A, defined benefit. B, defined contribution. C, old age security. And D, Canada pension plan. What do you think the right answer is? It is obvious that the right answer is C. As we talked about it, if you're making less than 79, you're good. If you're making between 79 to 129, 15% of So part of that old age security, you need to give it back. If you're earning more than 129K, all of old age security is gone, unfortunately. Let's get to the next topic. By the way, you're doing great. Employer-sponsored plans. We have covered government pension plans, okay? We are all worried about our retirement, okay? We're covering these two topics, government pension plans and employer pension plans, to make sure, okay, to understand, okay, how do we live when we are retired? When we're not working, do we get enough money? You need to understand these terms and these topics to make sure that if you're making enough money to survive when you're retired or not. And you as a mutual fund sales rep, your clients may be retired people. You need to be familiar with these terms. Let's get to employer-sponsored plans, or RPPs, okay? Registered pension plans, RPPs. There are two employer-sponsored plans or registered pension plans. Defined benefit plans, or DBP, and defined contribution plans, or DCP. What's the difference? Let's get to the points of first one, defined benefit plan. Retirement benefits are predetermined and not affected by the investment performance. Very important point. Point number two, employer, let's say you work for a bank X. That bank X promises a specific or a specified retirement benefit based on what? Based on a formula. But what factors that formula have? Your salary and years of service. So your employer promises a specified retirement based on a formula. That formula has two components: your years of service and your salary. Last point about defined benefit plans. The employer bears the risk and is responsible for funding the plan to meet benefit obligations, okay? Your employer contribute to an account, okay, to give you pension when you're retired. That contribution, that amount in the account won't just stay like that. Your employer will invest that amount, okay? Now, let's say in 30 years, it doesn't make sense that in 30 years that amount will reduce, because every even the worst investments will go upward finally. But let's say it does not meet the obligation, the promise that your employer made to you based on that formula. The investment didn't work well. Okay, your employer needs to pay from his or its own pocket to meet that obligation, to meet that promises. Let's get to the more common type of registered pension plans or employer-sponsored plans, which is defined contribution plans. The first one was defined benefit plan, which you as employee, you don't contribute to that. The second one is defined contribution plan. You as well contribute to that. You and your employer both contribute to that account. Or DCP, defined contribution plan. What points this one has? Retirement benefits depends on the investment performance. Now, the investments that are made in the account is really important, because your benefit is not based on a formula. It's based on the performance of the investment. Okay? Every year, 3%, this is the common percentage, okay? 3% of your income goes to an account. And your employer also matches that 3%, okay? Also gives that 3% or transfers that 3% to the account. Now, there is money in that account. You have two options. If it's like a group account, your employer will take care of it, but does not guarantee the success of that investment, okay? So, retirement benefits depend on the investment performance. And point number two, the employee means you, bears the investment risk and has control over the investment choices. You can say, okay, I want to do it myself. I don't trust my employer. I want to invest it in the stocks that I want. You can do that. So in the DBP, the employer bears the risk. In the DCP, you as employee bears the risk. Will you get question from this topic? And by the way, we're going to talk about different types of DBP and DCP, but will you get questioned? 100%. No doubt. And I'm not kidding. You will get more than 10 questions just from this chapter, chapter 6. This chapter is super important. Take it seriously. Okay? It's not a joke. But I hope I'm making it easy for you to absorb all information. Let's get to the question. Feel free to answer it yourself first. Which type of employer-sponsored plan offers benefits that are predetermined based on a formula including years of service, income level, and other variables? A, Registered Retirement Savings Plan or RRSP. B, Defined Benefit Plans or DBP. C, Defined Contribution Plans, DCP. D, none of the above. I'm going to help you. D is not correct. Also, A is not correct. RRSP. I mean, come on. It's between B and C, and we know that with defined benefit plans, option B, the employer promises a specified retirement benefit based on a formula considering factors like salary and years of service. So the right option is option B. Let's get to the next topic. Defined benefit plans, DBP. DBP. We have three types of DBP. Okay? Flat benefit plans, carrier average plans, and final average plans. I have compared these three types in four categories. We're going to talk about the definition of all of these types, pros, cons, and we're going to have an example for each type. Let's get to the first one, flat benefit plans. What's the definition? The monthly pension is a specified dollar amount of pension for each year of service. I'm going to elaborate this with an example, okay? Just stay tuned. But the definition of flat benefit, the term flat benefit plan, the monthly pension is a specified dollar amount of pension for each year of service. Let's get to the example and then we're going to go to pros and cons. Let's say Nav, which is me, and the full name is Navid, but I make it short and easy for you, Nav. Nav has a flat benefit of $25 per month per year of service. What's his monthly pension after 30 years? We have 25 and we multiply it by years of service, so 30, and his monthly pension will be $750. Easy peasy. Okay, this is flat benefit plan. Let's get to the pros or good points or advantages of flat benefit plans. The plan is normally funded entirely by the employer. Okay, and this plan is common for unions. Okay, you know, some industries have unions. Okay, this plan, this flat benefit plan, is very common in that type of unions, and it is mostly funded, so you don't pay nothing. You pay nothing out of pocket, out of your gross income or net income to fund this plan. What's the cons? So no difference between earning levels. Okay, let's say you started at bank X with the salary of 45K. You're retired with the salary of 100K. This difference, so when you are reaching to your retirement, your salary will go up. This is the general rule, okay? But this flat benefit plan does not consider that. It's flat. Just consider years of service and specified amount based and a specified amount, okay? No difference between earning levels. And another cons of this type of defined benefit plan is you need to renegotiate to keep up with the inflation. Okay, $750 monthly pension now is nothing. Okay, like if you start at bank X and you retired there, like once in a while you need to renegotiate to update that X amount per month per year of service. If you don't update that, if you don't renegotiate that, it won't keep up with the inflation, and the amount you will get, the pension you will get, would be nothing. Just nothing for you. Let's get to the second type of defined benefit plan, which is carrier average plans. What's the definition? The monthly pension is calculated as a percentage of an employee's earnings over the course of her or his career. Now we consider the employee's income. You know, you started low, you're finishing up high. We consider this average income. Let's get to the example to understand carrier average plan. Let's say NAB's average income in the last 30 years. So we do have income for each year. We calculate the average. The average income is 48K. Poor NAB. And NAB has a carrier average with defined benefit of 2%. So in carrier average plan, we have percentage. In the flat benefit plan, we had an amount. Remember that $25 per month per year? Here we have 2%. Now calculate his pension. His pension will be 2% multiplied by average income of those 30 years, which is 48, multiplied by years of service, or 30 is years of service. So the amount you will get is NAB's pension, carrier average plan pension per year. So $28,800 per year. Let's get to the pros of carrier average plan. Considers different earning. That's the pros. With the previous one didn't consider that. What's the cons? You need to renegotiate that percentage to keep up with the inflation. That's very important point. If you do not renegotiate, that 2% would be nothing. Okay. Let's get to the third type of defined benefit plans, which is final average plans. Definition: calculated as a percentage of an employee's earning over the stated period of time. The carrier average plan considered all the years of service. This final, as its name indicates, final average plan considers stated period of time. For example, it says best 3 consecutive years of career. They state something in the contract. They say best 3, best 5 years of, or best 3 of your last 5 years of employment. There is a term there. Let's get to the example. NAV's best income in the last 3 years are $52K, 54K and 56K, and has a final average benefit of 1.5%. Again, here we do have percentage. His pension plan calculated 1.5% multiplied by the average of the best 3 years, which will be 54, multiplied by years of service, he will get 24,300 per year as his pension. So I think you now understand the difference between final average plan, which we state a period of time consider to get the average of the income, and the carrier average plan, which considers all the income of your years of service. The pros of final average plan: considers highest earning years. That's true. That's fair. That's the pros of final average plan. What's the cons? If the earnings decline as retirement approaches, then pension plan will be lower, which does not make sense. I mean, I'm not retired yet. Maybe this happens, but maybe I don't want to judge. Maybe it happens. So if you get lower income when you approach your retirement, the pension you will get would be lower. Okay. Wow, what a topic. And will you get question? 100%. As I said before, this chapter is source of 10 questions. 10 is a lot. At least 10 on your final test. So take every single topic of this chapter seriously. Let's get to the type of question you may get. Nav has worked for 30 years. Okay? He has a final average benefit of 1.5%. His pension will be based on the best 3 consecutive years in the last 5 years of career. Calculate the pension. Year 26, 44K. Year 27, 54K. Year 28, 48K. Year 29, 56K. And year 30, 42K. How do we calculate it? We find the best 3 consecutive years, not the best 3 years of that 5 years. Best 3 consecutive years of the last 5 years, okay? Which are year 27, 28, and 29. We calculate the average income of by summing up these 3 years and dividing it by 3. The average salary would be $52,666. Then we calculate annual pension plan. Multiply 1.5% by years of service, which is 30 years, by the average income, which is $52,666. And you will get to the option C. What a great question. And you will get questions like this, maybe in a table, but the concept is exactly like this. Let's get to the next topic. Defined contribution plans, or DCP. Let's get into details of DCP. We fully understand different types of DBP, defined benefit plans. Let's now understand DCP. What's the highlight of DCP? The combined employer and employee contribution to DCP cannot exceed from the lower or lesser of the 18% of employees' current year's compensation, or the defined contribution limit for the year. Every year, CRA define a contribution for contribution room. For example, in 2021, the contribution room is $29,210. This is the maximum you can contribute there. Okay, so the combined contribution of your employee and employer would be lesser, cannot exceed from the lesser, whichever is lower. Okay, 18% of your compensation, or the defined contribution limit. What's the pros of defined contribution plans? Lighter regulations than DBP. This is one advantage. The second one, popular with small employers. Why? As it is easy to understand, easy to administer, and has fixed annual costs. So it's popular among small employers, small startups. What's the cons of defined contribution plan? The final pension amount is unknown until retirement. Why? Because it depends on the investment that you or your employer make. So members retiring under similar condition may receive substantially different pensions depending on investment and return over the life of the plan, which is true. Maybe two employees work for a bank, okay? They get same pension. This one is good in investing. This one is bad. This will get higher pension when he retires, and this will get lower pension when he or she retires. Is it fair? You judge. So these are the points of defined contribution plans. Will you get question? Again, no doubt, 100%. Let's get to it. In a defined contribution plan, the employer contributes a fixed percentage based on earnings. Okay? What is one disadvantage of these types of plans? A, limited control over investment decisions for employees. B, uncertainty regarding the final pension amount of retirement. C, high administrative costs for employers. And D, inflexible contribution limits for employees. As we said, the most important point about DCPs with defined contribution plans is we don't know how much we'll get when we retire. That's the most. With DBP, we know because it's based on a formula, and we know those three formulas now. three types, okay? So the right answer is B. Let's get to the next topic. Tax shelters plans. I'm not sure if you have heard the term tax shelter or tax sheltering. This is more common between those who are making lots of money. The tax sheltering term. Tax shelter have different programs, okay? The primary goal of tax sheltering is minimizing tax. You're making good amounts of money, but you're paying lots of it to government, okay, as a tax. Now, you have some ways to minimize that tax amount, okay? I have categorized tax shelter plans into 4 groups. Group number 1, immediate tax deduction. What's immediate tax deduction? The example is registered pension plans. So, we have talked about DCP and DBPs, defined benefit plan and defined contribution plans. These are under immediate tax deductions, okay? The amount is deducted from your gross income, okay? Before calculating the tax, the registered pension plans, the amount that you want to contribute to registered pension plans are deducted from your gross income, okay? This is deducted, then it'll calculate tax. So, registered pension plans are under immediate tax deductions. Group number 2, category number 2, annual tax deductions. Like what? Remember, the famous one was RRSP, okay? Registered Retirement Pension Plan or pooled registered pension plans are under annual tax deduction group. We calculate total income. We deduct the total income so we could reduce taxable income, okay? We do it when we're filing taxes on March, okay? So this is called annual tax. It is not happening instantly like the employer-sponsor plans, okay? Group number 3, no tax on investment gains. What's the example? What's the plan? Tax-free savings account. When you use tax-free savings account or TFSA, okay, everybody can open TFSA. We're going to get into details of TFSA, RRSP in future topics, okay? But when you open TFSA, you contribute a money there, and then you buy stocks under that account, okay? With the money in that account, you don't pay tax on it. This is another way of tax sheltering or minimizing tax, okay? Remember, if you do it out of that account, TFSA account, we need to report 50% of capital gain to the government. We pay tax on the 50%. But if you do it in TFSA, you don't pay tax. Nothing, absolutely zero. Okay? So this is the 3rd group. What's the 4th group? Tax advantage for education, or RESP, Registered Education Savings Plan, RESP. This is for your children, okay? You contribute to RESP, and that contribution, that amount, you trade with that account. You buy stocks, securities, different type of securities. You don't pay tax. You only pay tax when you withdraw, when your child goes to school and you want to withdraw an amount, okay? You pay tax then. You don't pay tax while trading and while playing with that account. So we now understand different type of tax shelter plans. The primary goal is minimizing tax, whether it's taxable income or net tax payable, okay? And So, yeah, let's get to the question. This was a very, very good topic. Let's get to the question. What's a key feature of a tax-free savings account, or TFSA? A, contributions are tax deductible. B, withdrawals are subject to income tax. C, investment gains earned is tax-free. And D, limit on the number of accounts an individual can hold. The right answer is C. As we talked about it, investment gains earned in this account is tax-free, and withdrawals are all tax-free. Feel free to read that white text, okay? It'll give you more information about this question and specifically about TFSA. Let's get to the next topic. You are crushing it. Registered Retirement Savings Plan, or RRSP, the famous RRSP. I'm sure you have heard it a lot if you're living in Canada. Okay? We have, we're going to talk about details of, we're going to see RRSP in 4 different perspectives. Tax treatment, how does RRSP minimize our tax? Contribution limits, withdrawals, what happens if we withdraw from RRSP, and determination, when does RRSP termination? So we're going to talk about these 4 points of RRSP. Let's get to tax treatment. As we talked about it, RRSP is tax deductible. We can reduce the amount of income that needs to be taxed. Let's read the text. When filing your tax, if you deduct your RRSP contribution from your total income, your tax bracket will reduce and you will owe low tax. Hopefully, will get refunds because you paid tax based on more income last year. That's true. Okay? Let's say your tax, your income was 80,000. You have contributed 10K to your RRSP. Now, when you're filing tax, your taxable income is 70K. You already paid tax on 80K. Okay? You paid tax in the previous year. Your tax was your income was 80K. You paid tax based on that 80K. Now you're saying, okay, now that we calculated and now that I deducted RRSP contribution, my income is 70K. Give my tax money back. That's why some people get tax refunds. Okay. Let's get to the contribution, how much we can contribute to RRSP. You contribute from your after-tax income. Okay? The tax are deducted from your pay stub. Now you have your net income. Okay? You need to contribute from that net income. You can contribute whenever you want through the year. There's no limit on the time. Okay? Whenever you want throughout the year. The maximum is the lesser of 18% of your annual income from the last year, or the dollar limit for the year. CRA each year gives us a dollar limit. For example, 29K. Your contribution limit is lesser of these two, 18% of your previous annual income, or the dollar limit of the CRA. Okay? If you contribute more, there will be penalty. The first 2K is fine. I don't know why, but it's fine, okay? The first 2K is fine. Above that, 1% monthly fine on extra. So, above your contribution limit plus 2K, whatever you contribute more than this, you pay 1% of that extra money as your penalty. Okay? What's the term deemed disposition? Let's get to this term. When contributing your already owned securities to your RRSP, so you own security. It wasn't in the RRSP. You did it just, you opened an account in Wealth Simple, for example. It's a Wealth Simple account. Now, you have securities there. You want to move it to your RRSP, okay? You need to add the capital gain when filing tax. This is called deemed disposition. Deemed disposition means transferring you already own securities to RRSP. Okay? It says, there's a point here. When filing your tax, you need to report the capital gain you earned from that security before, transferring it to RRSP. CRA is everywhere. CRA is here, there, everywhere. It won't let you go. Let's get to the withdrawals. If you withdraw X amount, okay, you need to add that X amount to your total income when filing your next year's tax. Let's read it again. If you withdraw X amount, for example, in 2023, okay, you need to add that X dollar. We're talking about withdrawal. You need to add that X dollar to your total income when filing your 2023 year tax in March 2024. So, this is brilliant. This is great. Clarifying, okay? We're talking about withdrawal of RRSP. You need to pay tax when you withdraw it, okay? But when the next year, when you file the tax of this year, we all file tax of this year on the March of next year, okay? Let's say you have withdrawn X amount this year. You add this X amount to the total income. Remember, we had 4 components of income. You add this X amount to that total income in the March 2024 or next year. Okay, what's the termination point? When you are at age 71, mandatory deregistration of RRSP is required. The maximum age that you can have RRSP is 71. When you're 71 age, your RRSP should be deregistered. Done. What happens to the monies or securities there? Then you have 4 options. Withdraw all at once. Okay? You withdraw it all at once. Purchase a fixed term or life annuity, which provides benefits to a specified age or for life. So option number one was withdraw all at once when you do register RRSP. Option number 2 is purchase a fixed term or life annuity, which give you a monthly income. Okay. Option number 3, transfer the proceeds to a registered retirement income fund, RRIF. We're going to talk about it in the future topics. And which provides an annual income. Great. So, let's say you are 71 years old. Now it's time to say goodbye to your RRSP. You have 4 options. Withdraw it all at once. Then you need to file the tax next year. Okay, your tax will be jumped a lot. This is not a wise option. Option number 2, buy a fixed term annuity or life. Option number 3 is buy life annuity. Okay, which will give you monthly income or monthly benefit. They will invest that amount and they will give you monthly income. These are insurance. Option number 4, transfer the whatever you have in RRSP to RRIF. That RRIF is same as life annuity with a little differences, okay? That RRIF will provide you annual income. Great. I think now you should be able to talk about RRSP between your friends. You should be confident about it because you know the definition, how it helps us to treat our taxes, what's the pros, cons, the contribution room, the withdrawals, penalties on withdrawals, and the termination. You know every aspect of RRSP. Will you get questioned? 100%, definitely. Let's get to the type of question you may get. John made an over contribution of $5,000 to his RRSP account. What would be the monthly penalty tax amount that John would incur for his over contribution? A, $30, B, $50, C, $70, and D, $90. As John contributed $5,000. The first two is fine. So he has contributed. I mean, it doesn't make sense. Why does the first two, there's no penalty? So they would increase that, add that $2,000 to the dollar limit. I mean, it doesn't make sense, but the first 2K is fine. The other $3,000. So the over contribution is $3,000. 1% of that $3,000 is its monthly penalty. So 1% of $3,000 is $30, and the right option is option A. Let's get to the next topic. Spousal RRSP. We have covered ins and outs of RRSP. Let's now talk about spousal RRSP. We're gonna talk about 4 aspects, the same aspects that we covered in the previous topic: tax treatment, contribution, withdrawal, and termination of a spousal RRSP. Let's talk about tax treatment. How would the spousal RRSP help us to minimize tax? By contributing to spousal RRSP, the higher earning spouse, reduces overall tax liability. Makes sense. Let's say we have 2 professional working. One has lower income, the other has higher income. Okay? This higher income can use spousal RRSP to minimize tax. Smart. So this is how spousal RRSP help us. Okay? To reduce overall tax liability and maximize the eligibility for government benefits or tax credits at retirement. All benefits of government, when government announces a benefit, hey, we have announced this to Canadians, they put a star and they mention the eligibility. They say, okay, this plan is for low income families, for those who make less than this amount. If you move or transfer part of your income to spousal RRSP, now you may be eligible for government benefits or tax credits at retirement. Okay? When the funds are withdrawn, they are generally taxed in the hands of the lower income spouse. We're going to talk about withdrawal in the withdrawal section. Okay. Let's talk about the contribution. The spousal RRSP does not provide extra contribution room. The room is as same as higher income spouses contribution room. This is about the room. Withdrawal. Any withdrawal of contributions claimed as a tax deduction by a contributing spouse, made in the year that the contribution is made, or in the 2 calendar years prior to the year of withdrawal, are taxable to the contributor in the year of withdrawal, rather than to the plan holder. Okay? We will get to this point in the question, okay? But it says so there is an account called Spousal RRSP, okay? The money wouldn't be there until we're died, okay? One day we withdraw from that account, okay? Now, what happens to the money? Who is taxed? If I'm the contributor, am I taxed, or my spouse? Which of us are taxed? Okay, this text is clarifying that. It says any withdrawals of contributions claimed as a tax deduction by a contributing spouse made in the year of the contribution, or in the 2 calendar years prior to the year of withdrawals, are taxable to the contributor in the year of withdrawal. Okay? Not the spouse or plan holder. Other than this scenario, the withdrawal from a spousal plan is taxable income to the spouse, not the contributor. If it's still complicated, I'm gonna talk about it in the question of this slide, okay? Don't worry. Let's talk about termination. Deregistration from the spouse can happen anytime, not 71 years old, anytime, okay? And maximum of age 71. I'm sorry, why did I say not 71? Okay, let's start again. Deregistration from the spouse can happen anytime and maximum at age 71, just normal RRSP, okay? Then the spouse has 4 options. Withdrawal all at once, purchase a fixed term or life annuity, same as the RRSP termination, okay? Or transfer the proceeds to a Registered Retirement Income Fund, RRIF, which provides an annual income. So deregistration is same for both RRSP and spousal RRSP. Let's get to the important question of this slide to clarify that withdrawal if you still have some complications here, okay? In each of 6 consecutive years, a husband contributes $1,000 to his wife's RRSP or to spousal RRSP, okay? Which he claims as tax deductions, okay? In the seventh year, there are no contributions, and the wife deregisters the plan. How much wife and the husband needs to add to their taxable income? A, wife has to add all this $6,000 contributed amount to her taxable income when filing tax. Okay, it's $6,000 in the account. We have $6,000 totally in the account. Okay, so option A says wife need to add all $6,000 to his taxable income. Option B says husband has to add all of this $6,000 contributed amount to his taxable income when filing tax. Option C says wife has to add $2,000 and husband has to add $4,000 of the contributed amount to their taxable income when filing tax. And D, wife has to add $4,000 and the husband has to add $2,000 of the contribution amount to their taxable income when filing tax. As I said, when deregistration happens, this question is saying deregistration happens in 7th year, okay? And the wife picks option A, withdraw all at once. When she withdraw it all at once, she needs to report that amount to add that amount to the total tax income. The question is, would just she do this, or would the husband needs to add it to his taxable income? Because husband is the one who is contributing. Now, let's get back to that point, okay? Any withdrawals of contributions to a spouse plan claimed as a tax deduction by contributing a spouse, me, okay, made in the year the contribution is made. So in 7th year, contribution was 0, okay? And or the 2 calendar years prior the year of withdrawal, okay? So the withdrawal happens in year number 7. Contribution was 0. Previous 2 calendar years, year number 6 and year number 5, they each had $1,000 contribution, okay? Me as a contributor, I need to add these years. So year number 7, year number 6, and year number 5 to my taxable income, okay? So I sum up these contribution in these 3 years. So $1,000 on year number 5, $1,000 on year number 6, 0 on year number 7, total of $2,000. So I add $2,000 to my total income, and my wife add the rest, which is $4,000 to her income. Okay, this is how the withdrawal works in a spousal RRSP. What a good question. And yes, you may get a question like that on your final test. So try to answer it. Try to absorb it and understand it, okay? Wow. Let's get to the next topic. Tax-free savings account, or the famous TFSA. Let's learn TFSA from 4 different aspects: tax treatment, contribution, withdrawal, and termination. Okay, how would TFSA help us to minimize our tax? TFSA is best plan for your investment. When you turn 18, so the criteria is age, and your age needs to be 18. When you turn 18, you can open up TFSA account and contribute, okay? Whatever you gain on your investments, which are in this registered account, it's all be tax-free. So if you're good in trading, TFSA is for you, okay? And you can have thousands of different TFSA accounts in different banks or different investment dealers or mutual fund dealers. So there's no limitation on having a number of TFSA accounts. Contribution. Each year, CRA announces the contribution room. Unlike the RRSP, which contribution rooms were function of income, for TFSA, it is same for all people. You can carry forward unused rooms, okay? So the contribution, each year CRA announces that, okay, this year $6,000 is contribution room for all Canadian. If you don't use that $6,000, if you don't transfer money to your TFSA account, you can carry forward that unused room, okay? If you, for example, if you don't use $5,000 of that $6,000, next year you can have $5,000 plus the plus the contribution room of that year. Okay, so this was about contribution. Withdrawals, you can withdraw any amount and whenever you want, and again, recontribute that amount if you wish. No tax when withdrawing. Wow, very cool account. No tax on capital gain, on investment income, and on withdrawal with TFSA because you already paid tax. You are opening that account with tax paid money. Okay? And remember, unlike the RRSP, TFSA is not tax deductible. You can't claim the contributed amount in your when filing tax. It's not tax deductible. The difference between RRSP and TFSA, RRSP was tax deductible, TFSA not tax deductible. Termination, there is no age limit for deregistering your TFSA account. TFSA was very easy peasy. Let's get to the question you may get on your final test from TFSA. Which of the following statements about tax-free savings account or TFSA is correct? A. Contributions to a TFSA are tax deductible. B. There are restrictions on the timing and amount of withdrawals. C. Income earned within a TFSA is taxed at a lower rate than other investments. D. Unused TFSA contribution room can be carried forward to future years. And I'm sure you got the right answer, which is D. Let's get to the next topic. Registered Education Savings Plan or RESP. Let's just study 4 aspects of RESP. Tax treatment, contributions, withdrawals, and termination. How does RESP help us? Some people say, well, why do I use RESP? I can use RRSP instead. Okay. If you withdraw money from your own RRSP, okay, and use that for your child's education, okay, you need to add that amount to your total income of the next year when you're filing tax, okay? And it'll increase your already high tax bracket. That's why you need to avoid using RRSP for your child education and open up RESP. Why? Because if you use RESP, your child needs to pay the tax. He is basically in lower tax bracket. When your child is withdrawing money, let's say he or she is 18. It's in it's not working, lower tax bracket, okay? So he won't pay that much tax on that withdrawal. But if you do it from your RRSP account, you need to pay lots of tax. This is why RESP is recommended. Contribution, lifetime maximum contribution is $50,000 per beneficiary. Okay, if you have 2 children, it's 100,000 grant. Okay, so $50,000 per beneficiary. Contributions can be made for up to 31 years. Okay. Government, there's a grant. Another reason to opening up a RESP if you have children. Government pays 7,200 CEGS lifetime grant. Okay. So 7,200 in the lifetime of that RESP account. Each year, 20% of the first 2,500 contributed by family. Okay? So there is no minimum or maximum contribution to RESP. It's just lifetime contribution limit, which is 50 grand for each beneficiary. But if you want to get government grant, government pays 20% of the first 2,500 contributed by you as a grant to your RESP. Great. How does withdrawal work with RESP? When beneficiary withdraw the fund, he or she needs to pay tax on the gained income, okay? Not the original contribution. The original contribution is not taxed. On the gained income, he or she needs to pay tax. If contributor withdraws, okay, if contributor withdraws, they need to pay tax on gained income plus an additional penalty tax of 20%. Let's say your child does not go to, he or she hates the school, does not go to school. What happens to RESP? You need to withdraw that money, okay? So when withdrawing, you need to pay tax on gained income plus an additional penalty tax of 20%. Okay? CRA won't let you go without paying tax. Termination. The plan ends under two conditions. Number one, within 35 years of its starting date, okay? Or number two, within 10 years of starting date, and if the beneficiaries turns 21 and do not attend qualifying programs. So, plan deregisters under two conditions: within 35 years of starting time, and or within 10 years of a starting time, and the beneficiaries need to turn 21 and do not attend any qualifying programs. Contributors are allowed to transfer a maximum of 50 grand of RESP income to their RRSP. Okay? If you need to have room available to your RRSP, you can just over contribute to your RRSP. No, you need to have room. If you have room, you can transfer maximum of 50 grand from your RESP to your RRSP as a father or mother. Okay? If the fund is not used by beneficiary, they need to pay back the CEGS. Remember, you got 7,200 in total benefits. You need to pay that back to the government. Government would say, okay, your children or your child didn't go to school, didn't attend, give my grant back. And you will be like, okay, government, here you are, your 7,200. Great. What a topic. What an important one. Will you get question? 100%. Let's get to the type of question you may get on your final test. What is the lifetime maximum contribution that can be made to a family RESP with two beneficiaries? A, 7,200. B, $14,400. C, $50,000. And D, $100,000. The right option is D. Why? Because we know for every beneficiary, the maximum limit is 50 grand. Two beneficiaries, 2 multiplied by 50, $100,000. Let's get to the next topic. RRIF versus LIRA. So, RRIF is Registered Retirement Income Funds, and LIRA or LIRA is Locked In Retirement Account. What are these? What's the differences? Let's get to RRIF. You remember when you register your RRSP at age 71, you had 4 options. One of them was transferring to RRIF. Now this is RRIF. transfer from RRSP when it terminates at 71. This is the first point of RRIF. The second point, you need to pay tax on withdrawals. RRIF is an account, just like RRSP, okay? Just the thing is, you need to close your RRSP by the age of 71. You transfer it to RRIF. Now, you got money there. It is invested or whatever. You got money there, okay? You need to use that money, okay? You will withdraw an amount. When you withdraw, you need to pay tax. It's just like your income. You need to pay tax on withdrawals. There is no maximum withdrawal limit. You can withdraw like all of your money from RRIF. There's no maximum, but there is minimum withdrawal limit each year. The minimum is calculated like with the formula of 1 divided by 90 minus age. This is the minimum annual withdrawal from RRIF. So, when you hear the term RRIF, it means your RRSP is deregistered. You need to say goodbye to your RRSP. Now your funds are transferred to RRIF. What's LIRA? Okay. Remember, you had registered pension plans or employer-sponsored plans, like defined contribution plans and defined benefit plans. What happens to them? When the time arrives to deregister those types of accounts, or when you leave your company, let's say you're not working for 30 years for the same company, okay? Your money in those accounts is transferred to LIRA, locked in retirement account. You need to pay tax on withdrawals just like RRIF. Okay, CRA is everywhere. At retirement age, okay, when you're retired, let's say at 60 or 65, a LIRA is converted into a life income fund or LIF. So there is LIRA, it is converted to life income fund or LIF. Okay, which provides a regular income stream for you. These are just bunch of different names which happen at different ages. Your RRSP terminates at 71, then RRIF. You leave your company, then you have money in RPP, you need to move it to LIRA. You retire, you need to deregister LIRA and move it to LIF. You know, it happens at certain different conditions and age, these different types of accounts. Minimum and maximum withdrawals limit. There are both minimum and maximum withdrawal limits with LIRA. With RRIF, there were no maximum withdrawal limit, just the minimum, which was that formula. Let's get to the type of question you may get from this topic. What options should Sarah consider for maintaining tax efficiency and income flexibility during her retirement when terminating her RRSP? A. Withdraw the funds as a lump sum. B. Purchase a life annuity with a guaranteed period. C. Transfer to a RRIF. And D. Purchase a fixed term annuity. The right answer is C. Transfer to a RRIF. Okay? Because that's the most wise option, most tax efficient option to transfer to RRIF. Feel free to read the white text on the right. Let's get to the next topic. Challenge number 1. When calculating RRSP contribution room, what is considered earned income for NAV using the information in the table. Okay? So, we're saying, remember RRSP topic, RRSP slide, the contribution topic aspect, okay? We're saying the lesser of 18% of your total income, or the dollar value, dollar limit that CRA announces is your contribution room for RRSP, okay? What's that 18% of total income? What's considered in that total income? Okay. Employment in this, so see that table? We have employment income, bonuses, dividends, net rental income, regular EI, employment insurance benefits, supplementary EI benefits, and pension adjustments. Okay? I haven't mentioned in the topic that what income, what type of incomes are calculated, are used to calculate RRSP contribution room, but here's a good place to learn that, okay? Earned income is your employment income, which in this scenario is 30 grand, plus your bonus, which is $500, plus net rental income, so we don't consider dividends, net rental income, which is 5 grand, plus supplementary EI benefits, which are 8 grand. So, in this example, in this table, we don't consider dividends, we don't consider regular EI benefits, and we don't consider pension adjustments. We don't consider them when calculating the total income to calculate the RRSP contribution room or limit. Okay, so we just considered employment income, bonuses, net rental income, and supplementary EI benefits, not regular EI benefits. Supplementary EI benefits are for disabled people and etc. And feel free to read that white text because it will give all the information you require when calculating RRSP contribution rule. Okay? So, great. Let's get to the... so the right answer is C here. Let's get to the second challenge. Challenge number 2. The information in the table is available about Nazila's final average defined benefit plan. What is Nazila's annual earned pension if, based on the average of the best 3 consecutive years of earnings over the last 5 years of employment? We had the similar question in the in previous topics slides. Please answer it yourself first, okay? If you got the answer on your hand, just continue this video. So, we find the best 3 years. Then we find the average of those best 3 years. Then we multiply 3% by years of service, which is 30, multiplied by the average of those best 3 years. Okay, so the only point is, and we get the annual pension. Okay, the only point that you need to consider is when calculating this is it says 3 consecutive years. It doesn't say best 3 years in your last 5 years. It says best 3 consecutive years. The only thing you need to consider is that. Great. Let's get to the next topic. Next challenge. No topic. Next challenge. Challenge number 3. Challenge number 3 is waiting for you. Sarah received $240 in dividends this year from ABC shares. ABC shares held in her non-registered account. Okay? All TFSA, RRSP, all of them are registered accounts. ABC Corporation is a taxable Canadian corporation. What is the taxable value of the dividends? Remember, we had 3 points when calculating total taxable income. Total gross income. We had interest income, no tax treatment. We have capital gain. If it was Canadian, we got 50% of that capital gain. We just report 50%. With dividends, we gross it up by 38%. So we multiply 240 by 1.38 and we get the answer, which is $331.20. So option D is right. I am sure you will get this exact same question on your final test. So, did you fully learn it? I hope so. Let's get to the last challenge. Last slide of this chapter, this long but exciting chapter. What type of investment income from Canadian source will generally be fully taxed? No tax treatment. A, dividends. B, business income. C, interest income. D, capital gain. The right answer is option C, obviously. We talked about it a lot. Dividends are grossed up by 38%. Capital gains, only 50% of them is taxed. Interest income, the business income is not investment income, of course. It doesn't make sense even. Option C, interest income are fully taxed. So, and by the way, feel free to read that white text. And yes, we have finished this long but fully informative and very important chapter. And can you believe it? You will get like 10% of your final test is just based on this chapter, chapter 6. And you've learned everything, ins and outs of this chapter. I'm proud of you. You are crushing it. Okay? Stay healthy, stay positive, and I will see you in chapter 6. So take care of yourself.
What's IFC? IFC stands for Investment Funds in Canada. It's the very first certification you need if you're aiming for a banking or financial advisor role in Canada. Think of it as your gateway into the banking world, setting a solid foundation for your career. How to register for this certification exam? It's simple. Head over to csi.ca, find the IFC page, click on the Enroll tab, pay the fee of $475 plus tax, and you're all set. You'll have up to 1 year to take your exam. What to read for the exam? Once you register, CSI will provide you the IFC book, which has 18 chapters and a total of 765 pages. If you commit to studying 4 to 6 hours a day, you will be ready in about 2 months. It's a big book, but with focus, you've got this. What's the exam format? The exam is flexible. You can take in person, at the specific times, of course, or online any day, anytime. It's a 3-hour exam with 100 questions. You'll need 60% to pass. But if you fail, don't panic. You've got 3 attempts. How are the questions distributed? Here's how the questions break down by chapter. Please take a screenshot. It's a lot to read. I'll wait for your screenshot. Now, how to make sure you're ready for the exam. MOCKEXAM.ca is your secret weapon. You'll find 6 full sets of practice tests totaling 600 questions that match the real exam in both format and structure. It's your final stop before exam day. Let's get the job done.